And that'd be the only caveat, is that we should still continue to respect bullish supply side fundamentals, but we have to have continued intact demand. For now, we do.
Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Well, we love talking with you about our ag commodity markets. And today we're going to bring in Joe Camp of Comstock Investments. He's been watching the market action from Wednesday here, and we'll talk about it now. Less than impressive close, I would say, on the grain markets here at midweek. Joe, what was the pressure?
Certainly a bearish tone for this week. It's the opposite, of course, of what we observed most of last week, that pivotal week, the election week, the Fed meeting, the crop report leaning friendly, ultimately for particularly corn and soybeans, and then no follow through into this week, in part because you had an extension of some moves that were ultimately, in a way, overlooked to a degree, or digested rather well, you could say, for the grains last week. And that would include the sharply higher dollar, the dollar index continuing to rally again here in today's session. Meanwhile, the crude oil market under that pressure. And we've talked about it several times over. It's almost like, whether it's the grains or the livestock, you come in the morning, you can look at first the stocks, the equity futures, the dollar index, and the crude oil, and you got a pretty good idea what's going on, or what will potentially conspire. So that's the case here. Still a higher dollar, mostly weaker crude oil, and nervousness about still the politics of it all. And that was expressed not only in the bean oil, for one, that should be brought up as a big point of the action this week, but in other ways that were just obviously broadly negative.
I see where the dollar index value is way over 106 now. At what point do you start to get concerned that it's really getting a little lofty and just causing more pressure on the ag trade?
Pretty soon we're bumping up north of 106, this real key ledge of highs that we had topped out at several times over in late 2023 and into all of this year. So anything much above 107, 107.05, I think there's a key high from a couple of Octobers ago. That clears the way for further strength up to where we were potentially at one point in 22, all the way up 114, 115 for that index. And so that's still a really long ride that we could be on, to the detriment, of course, of many commodities, the grains and livestock included, when we think about the export prospects being dampened, and then just generally that stronger dollar souring investment interest in the commodities.
Well, look how much money we've taken out of the energy market now, especially if you look at crude oil. And I just wondered how much of a dead weight, if you will, how much of an anchor is that on the corn?
It's a big deal because of the conversation that's linked to the processing market, and back tying into the political view going forward, and what is to be expected, or certainly what is still largely unknown about the direction of biofuel policy going forward. We had more on that, though, here these last several hours and into today's session. Some ramifications of President Trump's EPA pick coming into the storyline here. Not necessarily as much big oil as maybe the previous EPA selection, but certainly anti-big government, and that could include the Inflation Reduction Act in targets, and any other big programs that would potentially subsidize further expansion in the biofuel sector. So something worth watching for sure, aside from what we know to just simply be crude oil, and right now the sensitivity to margins that those ethanol and renewable diesel, et cetera, producers have. So it's the leader right now, lately lower.
All right. You and I were talking before we started this podcast recording here, that we seem to be kind of teetering on some support levels here on the grains. Talk about that, if you would.
Yeah, it starts with sort of middle of the range moving averages, because we had that strong election week. We had been building up, particularly for corn, on some recent strength that led to technical upside objectives being reached, new highs for the move. We bested that October top for December corn, but then not following through, ultimately now back down to points of resistance. Starts at, say, the 20-day moving average for that nearby corn contract. That is also in play for the January soybeans. Maybe the bigger deal would be that the January soybeans did hold for a settlement above $10 today. So that psychologically important mark is at play. Wheat probably looks the worst technically as it breaks down to new 3-month lows, basically. Now another leg lower, we could see this market go down to test the $5 handle for Chicago futures. It's technically very much still important that we watch what these chart signals are telling us, because we know those are influencing what the large speculators are doing. And that's a key part of this market that the commodity trading funds did. They turned net long in the corn futures and options for the first time since the summer of 2023. So that's one thing. But then still net short on the soybeans and wheat. It's a decision point on whether or not they probably reload on the bearish bets and think they can take them down towards those 2019 or 2020 lows, or it's time to continue this what had been a more solid corrective rally. And there's some signs that could still be in place, these points of support, but we need to act and hold them into the rest of this week.
How do these fund positions on the different grains compared to what they normally would hold this time of year?
Often we've seen in the past that you can get past harvest, you can get a lot of the producers selling to be bought up by speculators who would eventually be a general seasonal buyer into the spring, right? Particularly the row crops, corn and soybeans. We think about that spring uncertainty during the planting season and what's ahead for the new season, eventually allowing prices to rise into June or early July highs. But what we're knowing now is that maybe all bets are off if you talk about the historical seasonality, at least for now, because of all of the unique nature of this election and what's about to change, monetary policy, you name it, starting in 2025. So would say that we've got the potential for the spec funds to keep buying, but we're testing that here on this down week already right now.
Well, let's talk about the livestock trade. And on Wednesday, it was just kind of what I like to call a meandering market. I don't know if we accomplished much of anything there.
Both sides have unchanged, ultimately lower for the cattle, not out of order by any means, any extreme moves. And that came into play as well. The technical aspect of it, mostly inside days, the flips of what the grains are dealing with, having been on a big run to the upside, cattle futures corrected lower at the start of November, just ahead of the election and all of the risk there. There were speculators stepping out of those longs and taking profit, shedding risk, and then waiting to see. And now on the other side of that, they haven't found quite as much reason or motivation to step back into the market, not with the dollar rising, not with the overall trepidation in the grains about trade policy and everything else going forward. So that seems to be the rub of it. Speculative positioning, somewhat less bullish than it had been before on these livestock, and that applies to cattle and hogs. Hogs we bring up with the speculator because of those trading funds having now built up the last 2 weeks new record net longs in those hogs. So it's certainly a big macro type of money flow trade. The grains, the same thing could be said. It's a bigger degree that we're noticing this in the cattle and and hogs as well.
You know, Joe, aren't we kind of doing a high wire act here with the cattle? Remember last winter, it was pretty open. I mean, we really didn't have much of a threatening winter for cattle production.
Mm-hmm.
It worries me that the other shoe is going to drop, and we can't afford to lose many head of cattle because we're still trying to rebuild that herd. What in the world? What if we have a bad winter coming up here? What could happen to the market potentially here?
That seems to be more and more the calls for what to expect going forward would be a shift towards a lot potentially wetter and in some spots colder too. So that mix between whether it'll be slushy snow or just freeze is yet to be determined. And that'll really, of course, be what influences ultimately that cattle market. And when we talk about weight gains, efficiency, total loss, the numbers that you bring into play, yeah, that's what the market still appreciates, I would believe, is that the numbers aren't there to see really any loss from expected in terms of supply going forward. So Yeah, I continue to bring up the La Nina call and everything ahead, and it's kind of a spooky spot for us, and maybe reason why we're seeing this uncertain back and forth trade all of a sudden as we head into the now remaining 2 months of the year, and we'll see what happens with now the winter.
If the volume of cattle production is that tenuous, with the risk of a winter maybe turning to a little more nasty regime here this coming winter, do you think that tends to provide more support, a stronger floor under that cattle market?
It can and should, but it maybe only will if the demand end is not going to steal away the focus because of deficiency there. And that would fit with a recession or a big stock market sell off. If you have, of course, the beef market contract, prices come down like they did here over this last week, down about $8 for the choice cutout, closing back in on that critical 300 level for the choice average. You're seeing that those margins tighten up, and everybody wants to pull back and get concerned, and the speculators want to use that as encouragement to just step out of the market and get out of the way. And that's when sometimes the supply side fundamentals, as bullish as they can be overlooked. And that'd be the only caveat, is that we should still continue to respect bullish supply side fundamentals, but we have to have continued intact demand. For now, we do.
And remind me again how the funds are positioned on cattle and hogs.
Bullish positions, not new records, but like for the live cattle closing in on 100,000 contracts, that's a pretty hefty historical type of bullish bet on the cattle futures, and it's certainly helped.
All right. Well, Joe, thanks for explaining everything here at midweek. Always good to hear from you. I hope you have a good week, the rest of this one. We'll talk with you again soon. Joe Camp with us from Comstock Investments. That'll do it for this episode. We thank you for joining us. For producer Brianne Hendrickson, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.